We take our questions to Dubai to Bhavik Mehta, joining us from Century Financial. Do you think the Fed, Mr. Mehta, will go back to square one and will have two jobs to do, fighting core inflation and fighting headline inflation, which was has become under control somehow, especially when we saw a big decline in some petroleum products prices?
Right now, the biggest headache for the Fed will be any spike in the energy products. So we all saw what happened with the oil prices last week. WTI Brent, they were up by 8 to 9% range, and we also saw a decline in US equity markets, led by correction in the tech stocks. So I would say the biggest headache for the Fed, the biggest hurdle for the Fed would be further spike in energy prices, which would ultimately lead to price escalation in the core prices as well. So currently what is happening in US is the service part of the economy, the services inflation continues to remain high, about 5% rate on annualized basis. So this is where the Fed basically has its entire hurdle drawn on. So unless and until you don't see oil prices actually declining, the trajectory going down, Fed will be pressing its brake on any further spike in inflation, and they will sound as usual hawkish.
Mr. Bahavik, in the first question I asked about the big problems facing uh, the Fed regarding the expected hike in inflation this week. Also, we saw the non-farm payrolls in January jumping to 517,000, which came surprising and was way above expectations. How will this impact the inflation after the recent update in the forecast? We were expecting 6.5%, now 6.2% correction, as if there is some optimism by the Fed and the economists that inflation will decline, apart from other factors including non-farm payrolls and energy prices.
The Fed has to manage both the mandates, as you have said. So it doesn't just go by the employment numbers; it also go has to go by inflation. Inflation is stubbornly high, about 2% rate. Even when we say that the trajectory is going down, the labor market numbers are very strong. The January non-farm data, it surprised everyone, even the including President Biden. The White House themselves were not expecting such a positive set of numbers. So the Fed is definitely walking a very thin rope. It's walking a very delicate balance because their actions will be intensely scrutinized going from here on. So just this Wednesday, we are going to have the US CPI data release. Again, markets are expecting the prices to go up based on the spike in the gasoline prices. But the biggest hurdle, as I've said, everything will again boil down to the energy mix, the energy product mix, because ultimately that has been the entire inflation feeding narrative for the entire 2022.
What about the impact of strong wage growth recently, which is expected to continue? Meanwhile, when we look at the strong labor market, how can this particular aspect of inflation be fought against? Is if we talk about a terminal rate of touching close to 6%, do you think it can fight inflation?
So the Fed zone estimate is no terminal rate above the 5.25 range. But if you mention a number like 6%, it's not going to be taken well by the markets because as we've seen, markets always want to be complacent. Markets always want to look positive. As far as the core question of whether what could be the best terminal rate to fight inflation, that's anybody's best guess because so far over the last 3 month 3 to 4 month period we are seeing prices go down. But again, what Fed basically does is the current Fed setup, the current FOMC setup that is there, they basically want to prepare the markets for the worst case. So if you see most of the statements made by Chair Powell and all the deputy speakers, they are indicating that markets should brace themselves for a mild recession, for a growth slowdown, if nothing major expected. So, in all likelihoods, terminal rates again going beyond the 5 to 5.25% expectations is another leg down for the market. Inflation continues to be a very tricky thing, and to give a perfect ballpoint estimate, Should the current inflation prices again rise above 6 to 6.5% range, the Fed will definitely increase its terminal rate beyond the 5.25 to 5.5% range.
There is also expectation for the PPI also Thursday. How important is this, and how will it impact the economy and U.S. markets?
PPI is a measure which basically shows us the inflation at the core wholesale level or at the exact factory output gate producing level. So there have been instances where the spike in PPI is not actually reflected in CPI, or let's say the PPI is increasing but the CPI is going down. The entire inflation, the entire focus of the Fed and the markets is primarily going to be on the CPI data. But should a PPI print come absolutely on the larger side, that would basically indicate inflation again creeping on the manufacturing side as well. So that would be another major worry sign for the markets.
You mentioned a few minutes ago that markets will not accept higher than a terminal rate, and it doesn't seem to be related to the markets also, but the reading for the economic fundamentals and numbers and data. And markets are ignoring what Jerome Powell is saying and his decisions. Do you think this situation, overlooking by the market, will be the main characteristic, regardless of what he does and what statements come from other Fed members and also Fed chairs in other states?
You are absolutely right. Markets have turned complacent. Markets are not looking at the reality that the US economy is strong. You look at the labor data, you look at the inflation data that is holding up. So the markets are in a denial mode. They do not want the Fed to go above the 5.5 to 5.25 terminal rate. But should the incoming data actually warrant, I don't think so. Chair Powell is going to mince his words. He is going to go all out, or all is going to be again completely hawkish as far as this inflation fighting mode is concerned.
Bhavik Mehta, thank you
Thank
so
you.
much for having joined us from Century Financial. Thank you, sir, for
Thank you.
having been with us. Please.